A lot of funds in the space, but particularly crypto funds, like to say they are thesis driven. We take a bit of a different viewpoint on this and frame it as we are founder driven more than anything. And kind of the name archetype points to the idea of different founder archetypes that we look for.
None of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Wagme Ventures or any of its affiliates to buy or sell any securities. Hey Wagme family, Benga here with another Wagme Ventures podcast. Today we're going to be chatting with one of the OGs in crypto investing, Dmitriy Berenzon. He's a partner at Archetype Fund, an early stage venture firm focused on investing in top founders, projects that accelerate the decentralized future. For anyone who is new, this is the Wagme Ventures podcast, where we do snapshots with interesting builders and founders across crypto and AI. Check out wagmeventures.io to learn more about the syndicate behind the podcast. Let's get into it with Dmitry. Hey, dude, welcome and thanks for being on the show today.
Yeah, for sure. Thanks for having me.
Great. We both started our professional careers at Deutsche Bank. That's amazing. And then pivoted to crypto. Just what gave you the conviction that this technology space is where you want to continue your career after Deutsche?
Yeah. I mean, it was a long process for me. I came across it at first in 2013, actually, when I was doing research for the bank's head of payments. And our offices were on Wall Street at the time. And there was this place called the Bitcoin Center that was right near the New York Stock Exchange. And I used to go there and see people trading Bitcoin peer-to-peer and selling custom ASICs, and saw Vitalik there in 2014 when he was doing the Ethereum ICO. And I remember, being in the crowd and seeing no one had an idea what proof of stake was. He was talking about energy inefficiency, truly ahead of his time. And from that perspective, I thought, okay, this is really something that people use to buy drugs online. So was not really excited about that. And obviously hindsight's always 2020. And then later on, so I spent my last 2 years at Deutsche Bank building out their innovation labs. And we were doing a blockchain proof of concept in 2016 that was effectively using smart contracts to automate business flows. And I said, okay, maybe some use cases outside of payments, but still a lot that needs to be done around regulation and developer tooling, and still wasn't bought in. So decided to do a career shift and went to Berkeley for business school, and was not particularly thinking about going into crypto, but met the Blockchain at Berkeley group and thought that they were all particularly inspiring and just frankly 18-year-old galaxy brains. And they had this really good course on Bitcoin, more from like a distributed systems perspective. So that was finally my aha moment in 2017, looking at it more from a DeFi lens, kind of saying that the last 30 years of innovation in fintech was a pretty front end on top of 19 infrastructure, but at least with Ethereum and Solana, we have 2015, 2018 Rails. So that was a big thing for me. The second thing is around the idea around meaningful work. And there's a lot of literature about this, but generally for people, you can bucket it into mastery, autonomy, purpose, and belonging. And it's never one of those. It's often some combination. And what I learned a bit later in my career, kind of reflecting over 6-7 years of professional work experience, is that I particularly get motivated with mastery, more so than anything else. And when I looked at crypto, to me, it was almost like a choose your own adventure, where from a macro level, I get to know more about a topic than 95% of people in the world within crypto itself. If you want to learn more about cryptography or distributed systems or finance, game theory, politics, it was really like this never-ending skill tree that I can traverse. And that was incredibly motivating for me.
Yeah, that's fantastic and fascinating when you use the word mastery. And by the way, I still have fond memories of essentially starting the career on Wall Street and all our favorite watering holes. But yeah, you use the word mastery and being able to create your own adventure. In many ways, I think of like investors as innovators. And so maybe that extension of mastering what you see in crypto today and how you can definitely help in the evolution and the build out of it, right? As investors, you put yourself in a founder's seat and you're able to see the bigger picture and vision and how the long game plays out. Can you share how you sort of transitioned in saying, hey, I want to be a master in this space, and transition from that and say that for me looks like crypto investing?
Yeah. I mean, I remember it was over a summer I was working. So my first role in crypto was an investing role with CoinFund, who are awesome people. And I learned a ton from Jake and Alex around token value accrual. And I remember being in the office there and working 12, 14-hour days and feeling like this doesn't feel like work at all. And I felt very grateful for kind of recognizing that. And it kind of made me realize I can outwork people because it doesn't feel like work. So I think just seeing how the dynamic there was very inspiring for me. And then I had also, I guess I didn't mention, in business school, I was working on a startup for about 9 months. It was a portfolio management tool and robo-advisor. And I think about that now, and it's kind of funny because the purpose was around risk mitigation and portfolio diversification. And turns out people in crypto still only want leverage. So that was quite literally the opposite of what anyone wanted. But it was very difficult for me. And I ended up sunsetting that prior to starting with CoinFund. But it definitely gave me some empathy around how difficult it is to actually build a company. And crypto is an order of magnitude more difficult than traditional startups because on top of all the other issues you then have to layer on your market structure quite literally changing every 9 months. And you're kind of like trying to build a building on top of like tectonic plates that are moving very quickly. And just like the personal founder risk, being in a regulatory gray area at times. And I wanted to support the people who were out there in the arena and frankly doing something that I found was very difficult for myself.
Wow, fascinating. And while Archetype needs no introduction to many of us in crypto, right? Can you just share with our audience who is Archetype?
Totally. So we are a New York City-based venture fund that's focused on backing founders who are building from 0 to 1 with a deep dedication to their craft. We're investing out of 150 million fund 2. We are a team of 10, all based in New York, in Soho, in office 5 days a week. So very boomer pre-COVID, but we find it works quite well for us. And we have a very big vision around what we do in New York. The vision is in a year, whenever anyone thinks of NYC crypto, they think of Archetype. We effectively have productized our office space here and use it as a distribution channel for founders. So we do a ton of programming here, from monthly happy hours to research days to whiteboard sessions. And we probably have around 1,500 people come here every year across these events.
That's amazing. So not just the fun, but a bit of a community to just support founders in their journey as well.
Totally. And I think it's a pretty unique point in time. I don't know how long it'll last, like how long New York is going to continue to be a gravity. But I frame it as like there's quite a deep like founder liquidity here. So it's relatively easy for us to just spin up an event, have a founder that we want to talk with either already here or flying through here. And we think that it's important to try to let people establish more organic in-person relationships because we're all so used to talking to a head over Zoom, which is fine. Crypto's a marathon and burnout is very real. And I think the way you get through it is if you create a community of people. And we're trying to really be the space where folks can actually connect.
Yeah, that's pretty awesome. Yeah, to your point, that founder liquidity, I think New York continues to attract top talent because of the resources, the community, the fact that it is the world financial capital of the world in many ways, and with a lot of crypto use cases coming out of all of that, I think it still, to your point, continues to be the center of gravity for a lot of that activity pool in many ways. But just going back to Archetype, can you speak a little bit about your investment philosophy and how this has framed your investment thesis for this cycle?
For sure. I mean, I think a lot of funds in the space, but particularly crypto funds, like to say they are thesis driven. We take a bit of a different viewpoint on this and frame it as we are founder driven more than anything. And kind of the name Archetype points to the idea of different founder archetypes that we look for. I think for me personally, I take some inspiration from Tony Conrad from True Ventures. And I remember seeing a panel with him in 2017 where he was talking about Blue Bottle because True invested in that. And he was talking about the founder. And he's like, I saw this guy and he could not stop talking about coffee and he just loves coffee and he was so passionate about coffee. And I realized that he's going to will this company into existence. And he talked about that founder, I forget his name, around being the face of a movement. And he often looks for which founders can be faces of movements. And I think there's definitely a framing there in crypto around like, can the founder lead a cult? But that's like one flavor of, I suppose, an archetype. But that's definitely how my personal investing style has evolved over the last 6 years. But I think that's a pretty important point. We do thematic deep dives as guardrails and to allow for focus. And I think that's like one important element. The other element in general around investment philosophy is having it be quite heavy on being time weighted, in the sense that I do think everyone is eventually right. But I'm sure you know the story of Webvan. This is effectively Amazon Fresh, but 20 years ago. I forget the amount of money that was invested. It was an asinine amount. They burned through all of it. They had these giant warehouses where they were storing and cooling food, and they were trying to get people to order delivery online, but there was just nowhere close to enough of the internet penetration that would have made it economically viable. And I definitely look at that in crypto and say, like, there were a lot of ideas from 3-5 years ago that was just wrong timing. And I think it's very easy for investors to apply algorithms in their head. And I think it saves calories. And I think like we're just like conditioned as like animals to like save calories for survival. So we often don't want to think about the next step. But I hear a lot of investors say, oh, like this idea never worked. And I think there is actually the alpha in the one time that idea does work. And then oftentimes that is around timing. So that's something I have put increasing weight on as well.
Yeah, no, and it makes a ton of sense. I mean, you see what's happening with prediction market projects today. They've been around for some time, but it's only recently they just seem to be the darling of the investment space, but also the community overall. So yeah, there is definitely that time-weighted piece in how you approach investing. And I'm pretty sure as you look across crypto as an emerging tech and time-weighted opportunities or plays that you think might be a movement, if you will, it still all boils down to the infrastructure of crypto that as an emerging tech. And as I look across your portfolio, there are a lot of projects that you're invested in that carry that same theme, like infrastructure, which makes sense. I mean, crypto's new, it's still building, there's still a lot to solve. But what is your thinking in how you sort of focus on the infrastructure piece and solving for that?
For sure. I mean, we are generalists across crypto, and we have done quite a number of consumer investments like Farcaster and Sound at XYZ. But I do think that the opportunity continues to exist in infrastructure. And I think the nuances, I would bucket it into infra for UX and infra for scalability. And I think there has been a lot of, I guess, like crypto Twitter rumblings that we're over invested in the latter for scalability. I would also then reframe scalability in terms of what it means for the end user, which is cheaper transaction costs at scale. That's how I kind of frame it. And I still don't think we're there. And I think it makes sense to continue to invest in scalability until we are actually able to support millions to tens of millions to hundreds of millions of people that are all executing some transaction on chain and giving them some sufficiently cheap enough experience. I think scalability also has a nuance in direction. Like we're also investors in Lagrange. So they're kind of scaling verifiable computation. And I think that's another area that benefits from power laws, from improving hardware. We're also investors in Movement Labs and Essential. I look at that as like scaling Ethereum more broadly. And on the UX side, we're also investors in Privy, which provides embedded wallets and really trying to give users the experience that is more equatable to a Web2 experience. And we've kind of realized that one of the byproducts of the Ethereum roadmap and having probably hundreds of L2 and L3s is fragmentation. So we're investors in Socket, which focuses on interop and chain abstraction. And so I think you kind of have infrastructure that also helps solve, I suppose, like some of the issues associated with prior infra that starts to get commercialized. But I think there's still a ton of opportunities on both sides.
Got it. And just thinking a little deeper on the infra side and with one of the core verticals and narratives in crypto today, which is DePIN, where do you think DePIN's going to from here today? Because I don't know. I don't feel like 2 years ago, 3 years ago, 4 years ago, it was that popular. There were certainly like strong projects operating in this space already, but it does seem to have gotten new life recently. And would just love to hear your thoughts on what you think that is and where DePIN as a vertical itself can potentially go from here.
Yeah, for sure. I mean, I think a lot of the historical projects were around DVINs, if you want to split that, where you have the physical and it like you can stretch what physical means. Like I can argue Bitcoin is a DePIN because ASICs are hardware. But generally, you can bucket it as like DVINs are virtual resources like storage, compute, and bandwidth. And then DePINs are around wireless, geospatial, mobility, energy. And I think historically, there was a lot of experimentation on the DVIN side. I still remember trying to set up a Golem node in, 2019. And that's where you bucket Arweave and Filecoin. And then more recently, I think probably Helium started the wave of interest. And I think that's where we have seen more of experimentation on the physical side. The framing I have is crypto is very much like the internet in the sense that the use cases that start to pick up is a byproduct of the persona that discovers crypto and why it's particularly powerful. And we've seen this initially with the Austrian economists and with Bitcoin, and then the finance people like us, I suppose, with DeFi, and then the artists and musicians with NFT. And then I think DeSci are like the biology PhDs, and DePIN is like the electrical engineering PhDs that discovered that tokens and networks are quite powerful at incentivizing large-scale human coordination. And I think a lot of the experimentation on the DePIN side has been around this kind of supply-side network bootstrapping, which I don't think is an argument at all at this point. Like I think it works. Tokens are an incredibly powerful mechanism for crafting like very specific behavior that you want someone to do. I think where it goes from here is a lot of these products will need to prove that they have real demand. Like after you bootstrap a supply side, is that actually something where there's a willingness to pay, and can you make the economics work mid to long term for a network? And I think we will see many failed experiments, and I think we're probably coming close to the peak of inflated expectations for DePIN, kind of looking at the curve there. But I think that's fine. And I think, again, it kind of goes back to timing. I'm particularly excited about on the virtual resources side. The thing that's different today is AI. And I think that's going to be a catalyst for generally like data and compute, because I think that AI is like electricity in the sense that the more you have of it, the more you can do with it. And I think a lot of people initially looked at these compute networks as a short-term price or supply arbitrage. And I don't think that's true. And that the demand for these compute networks will generally scale with the adoption of AI. So I think we're going to see some very real projects come out of that. And the thing they need to hit is effectively like SLAs, like service level agreements, like basically an experience that is competitive with centralized counterparts. Because I think they will be cheaper from a economics perspective, from a supply and demand perspective. They will still have overheads from latency, redundancy, potentially cryptography and consensus, but I think we're just going to have more machines. But I think you need to abstract it enough where a company doesn't even know that there's like a crypto network under the hood.
Hey everybody, quick thing here. We're excited to announce WAGMI Advisory, your home for all things fundraising, hiring, and partnerships. This is all about supercharging your project with the WAGMI network, consisting of over 20,000 executives, investors, and builders in crypto, all ready to come alongside your project to help it succeed. Get in touch at team@wagmiventures.io to learn more and figure out if WAGMI Advisory is the right fit for your project. Let's get back to the show.
Yeah, no, that's pretty fascinating. Your thoughts on AI and DePIN. And right before we actually go into that, you mentioned Lagrange earlier as one of the other investments. And I bring it up because you wrote a pretty extensive and beautiful piece on verifiable compute and how it's poised to become as important of a technological revolution as blockchain itself. And I just thought it would be really nice and helpful if you summarize your thoughts and your feeling on that for our audience.
Totally. And I think a lot of people, like, I will frame verifiable compute as ZK. And so like, why is ZK special? ZKPs, they effectively turn code into math. That's like the TLDR in my head, where you can effectively model the physical logic gates and circuits that make up a program as arithmetic gates and equations that give you an equivalent output for that program. And that's a very powerful concept. And it stands on the shoulders of giants. And there has been probably, like decades of research that has gone into this. And the issue historically was that doing this is expensive, like computationally expensive in the sense that one, let's call it like a CPU cycle for a regular computation equates into like 100,000, let's call it, cycles to be a ZK prove it. So it's quite literally orders of magnitude more expensive. But there has been a lot of research over the last 30 years that has basically shifted the complexity curve from exponential to logarithmic, meaning that before it reached the limit at some point, depending on the complexity of like the number of computations that you have to do. And now with better algorithms and hardware, we can effectively do a lot of the computations that were previously not feasible. And why this is important is when you think about what blockchains do, or like why like Ethereum or Bitcoin is important, what you effectively are providing is economically guaranteed computational integrity by having multiple untrusted machines re-execute the same programs and agree on some end state, right? And so you have like 1 million Ethereum. So they're doing a lot of re-execution, and that's quite inefficient, is what I would argue to someone who's saying that ZK is inefficient, where it's like 100,000 times overhead. Like, yes, but the Ethereum network is doing this like 1 million times. That's stretching it. But with ZK and verifiable compute, that effectively provides you mathematically guaranteed integrity by proving that some end state is the result of some set of inputs into some program. And so you can have a very different model for a blockchain, and it's kind of secure and verifiable by design. And maybe the only thing we will see in blocks, or maybe the only thing that should be in a block, are proofs.
That's pretty fascinating, and sort of like how you've been able to just go in there and help understand like what's going on with verifiable compute, because we hear it a lot and you see it being dropped everywhere and really not explained in sort of like the detail in which you sort of share here. So thank you for that. And again, going back to Archetype and sort of your view of the world, some of the exciting projects you guys have invested in, from Rio to Monad, Movement Labs you mentioned earlier, Socket, Obol, all great projects, all amazing use cases, and sort of form part of the Archetype family. When they come to you, like, what does your due diligence process look like? Like, how do you get a sense of the quality of the projects, the future success of the projects? Give us some insight there, if you don't mind.
Yeah, the classical lens that I use, so the very easy framing that I have is I call WTF. That's like a very simplistic mental model for me to like start off with, where it's an acronym. W is like to use, so it's unfair advantage and unique value prop. So why are you special? Why will you outcompete? T is team technology traction. So how good is your team? How good is your tech? What have you done in the last 6 months? And F is kind of funding and financials. So how do the deal economics look like? That's something that I use as like a boilerplate. And then there's more of a crypto native lens that I apply, which is token value accrual. Like, how is this going to be valuable? Does value indeed accrue to the token if that is where the project is heading? Does the founder or the founding team, do they have what it takes on the side? And then BD and like narrative building in crypto, it's a bit of a different flavor, I suppose. But I do think it takes like almost like an always on mentality. Like, can I picture this founder being like omnipresent across every like conference and podcast and Twitter space simultaneously, and then not burn out after a year? And generally, like, where is their market interest? Like where is their general narratives? And then the last is, I think I mentioned before, around like the founder lens. Like, is this founder product fit? Are they uniquely positioned to build this out? Do they know some secret that no other founder or project currently has, that insight that will have them build something that is like either novel or it can be a better go-to-market? And then I think we approach all of that with a very open conversation with the founder. I think we can move fast when we need to. And one important thing that we also do is have more of the reference calls. I think there's a bit of frustration around investors almost like blindly investing into narrative. Like I don't think narrative is bad because it does represent like a collective consciousness around what is particularly interesting in a space. And I do think that there's wisdom of the crowd, but I think we should back that up with actual like conversations. And I think that's a big part of our process, where if a project says, oh, like we're partnering with like XYZ, I will reach out to XYZ. And I've just today, I reached out to X and they're like, oh, we never heard of this project before. I'm like, okay, that's good to know. So I think that's something that we lean on pretty heavily.
I know that's pretty interesting. Like the different pointers and pieces of the used to evaluate them. I thought it was particularly curious, just even understanding like the energy level. I think there is a flavor of what you had shared earlier about like, can the founders start a movement and piece together some of the, how you create that framework or the check boxes. But yeah, I think every fund has a different approach. Obviously, there's some things that are similar, but then there's the secret sauce that sort of helps identify who the winners are and where the bigger plays can be made.
For sure.
And in that same breath, like when you bring all this to bear, and maybe this is too early, but are there investments that may have potentially gone sideways or that things didn't go as planned, which sort of helped to build or revisit how you built the due diligence process so you can catch that earlier in the process? Any stories there?
I mean, I think a learning is probably the danger of too high of evaluation. And it's been something, and I feel so strange like saying it as like an investor, because everyone's like, oh yeah, obviously you're just saying to lower valuation. But I think it could actually really hurt a project. And I think in crypto, the valuations are orders of magnitude, probably more than what we see in traditional venture. And I was having dinner a few weeks ago with more of like a traditional AI investor. And he's like, oh yeah, we're doing like this investment in like a AI company in France at like a 4 million cap. And that's like a third or like a fourth of what in crypto. And I just saw a investment that was at 100 mil cap first round. So that is, the distortion is insane. And I think what the founder is doing is putting themselves on, like they just have more to prove. Because if you're underwriting it at say like 100 mil as a founder, you need to do enough between now and your next round, whether that's in like 9 or 15 months or whatever, to deserve a step up. And it, like the investor is underwriting it. They often do it as a way to compete, or they're just like in a very hot area that, you know, like narratives are like pushing like the val up. But the hangover from that is painful, especially if the team needs more time to actually execute the vision. And maybe it's like poor market timing, but maybe like they have to do a bridge round. And the ones that have raised that too high of a val, which like anecdotally, I don't know, like 60 mil FDV on your first round, the flat and down rounds are incredibly demoralizing for the founder and the team. And you kind of hamstring their general like motivation. And I've seen like one company, I mean, it was even less. They did their first round. It was like a 45 mil cap on, and now that like they have growth, but they can't get the unit economics to look good. So they're growing more, but they're burning more. But it's very real PMF. They just got an offer for a 15 mil cap down round, and that's crushing. And he just doesn't feel great about it. So I see these scenarios, and I think that crypto investors collectively just need to do a better job with underwriting and pricing these initial rounds as something that is more, I don't know, down to earth, because I do think it actually helps the founder in the mid to long term.
Right. No, that's an excellent point. We have seen folks who have come in at high valuations, and especially with the recent crypto market, really struggled to sort of meet those valuations or even validate such numbers, and how that's affecting even the next round, because at least of course, most folks don't want to do a down round. It's also not a good look if you're trying to grow and potentially IPO in a relatively short period of time. But yeah, it's good learnings. I imagine that's something that, as founders sort of like congregate around Archetype, that they have opportunity to engage and learn and sort of have like that osmosis of education, not just viewing maybe product development, but investing. And I'm going to just think about like the community you've sort of created. And I think it even has a name, right? The beanpool.nyc. Would love you to share more. I'm sure there are many other topics outside of valuation that is discussed there, but what sort of just want to learn what you guys are doing with this.
Yeah, so mempool.nyc was an attempt to literally create a database. We're just like we know a ton of founders and funds here. Why don't we just create a central repository for them to be able to connect with each other? So if you look at the website, it's very bare bones, but it's something that we maintain live and we have it quite deeply integrated into like our CRM. So like whenever like we see, there's a new company in New York, we add it to mempool. The cutoff, because like what does it mean for someone to be in New York? We frame it as like, I don't know, C-suite or like C-1 to have some like substance or like some gravity in New York. And we released it with 180 submissions and we're at 450 now. So that's quite a gravity. I think there's probably several reasons why New York. One was path dependence with COVID. I do think crypto people tend to skew a little younger and I think people were just like bored in other cities and they said, hey, like, let me move to New York. And they're like, oh, that's kind of fun. I'll stay. And then the other was success of other companies, particularly Uniswap, OpenSea, and Zora, that I think became quite big and well-known and that created a flywheel. I think where it made it less taboo, I suppose, to work in crypto. And like this happened in Berlin with like Rocket Internet back in the day, where like that was like a large like e-commerce like startup venture builder. And like Germany's pretty conservative. And so working for a startup was also seen as a bit taboo. But in Berlin, I think Rocket Internet, the success of them kind of kickstarted that movement. And I see like a similar analogy here in New York. So we're kind of leaning into that. And we recently expanded it to add events. So anyone that's hosting an event in New York can submit it and we'll add it. And then we're trying to build towards almost like a real-time view. That's kind of like where the idea of mempool came from. Because you don't need someone to be here permanently, but if they're here ephemerally for a week, 2 weeks, to give them a way to like discover other people in the crypto community that are there as well. And it's been really well received. And there are some other cities that popped up and used it as inspiration. I think like Toronto or something. But yeah, I think it's a net positive for the space in general.
Awesome. Well, before I end the show, one of the things I'd like to ask our guests is to tell us about what else they find exciting in crypto. But instead, I'm going to ask you two questions. One is what verticals you see strong convictions in today in crypto. And then I know you also recently opined on the massive network effect of stablecoins. So clearly you're a fan. And you talked about like the two new flavors of stablecoins that are emerging. I think it was like application specific versus ephemeral stablecoins. So we just want to hear your view on, what very strong convictions and then where you see stablecoins going today. Is it truly the crypto killer app, as folks are calling it?
For sure. On the verticals, I think one area we continue to be excited about is the intersection of AI. And I do think it's an area that's still met with skepticism. And I think that's good. And it should be healthy skepticism. But I do think the fundamental principles of the two technologies do lend themselves well to working together, because AI is fundamentally a tool for abundance and creativity, but it's also a very centralizing and controlling force. And I don't need to name the country, but it's already being used for oppression today. And crypto is a tool for self-sovereignty. And it allows for the development of platforms and applications that don't have a centralized owner. And I think that works quite well, especially when you look at the direction in which AI is heading, because it continues to be more centralized. And we're effectively in this intelligence arms race where companies are spending tens of millions of dollars to train these new foundational models. And for GPT-4, for example, it cost $100 million and 25,000 A100s running 24/7 for a month straight to train that. And it's expected that these costs are going to go up to the billions over the next few years. And so with that market structure, effectively what you have is 10 people in a boardroom at OpenAI or Google deciding what data should be the input into a model and how that model is steered. And we do not think that's a good scenario for society to be in. And so we think that crypto can offer tools around incentive and coordination mechanisms, going back to tokens being very powerful. We think that we can use tokens to coordinate the contribution of expertise, data, and capital to create, train, and monetize models. We also think that crypto can serve as these native economic and payment rails, effectively, where you can effectively facilitate global real-time micropayments. And that would particularly be used by agents. And I think that's a term that you'll probably hear more of over the next several years, but we frame it as a system or entity that has the ability to execute workflows or transactions on behalf of a user without that user explicitly programming it in. And agents in Web 2 are becoming increasingly useful, but there are certain things they cannot do. They cannot have a bank account. They cannot accumulate or distribute monetary resources. But with crypto, agents can own a private key. They can have a wallet, so they can programmatically execute these financial transactions, both on behalf of users and with other agents as well. So I think that's quite powerful. And when you look at the AI crypto stack, you have the data and compute layer at the very bottom, the let's call it the model layer, where you have your open source LLMs and your diffusion models, and then at the very top you have these crypto rails and applications and coordination networks like Ritual. So we're quite excited along that stack, and we've made a number of investments there. On the stablecoin side, I'll loop it into another area I've been looking at, which is payments, and it kind of goes full circle. And I think this, I got triggered after ECC this year when people came back crying that there are no use cases. And I'm like, guys, stables and payments are mainstream at scale today. People want digital dollars. On the stable side itself, where I still don't know, the answer is will we have 3 to 5? Will it be a power law? Is it going to be USDC, USDT, and maybe 2 more? Or are we going to have every bank and every fintech issue their own stablecoins? And will we have only stablecoins in US dollars? Or are we going to have effectively a stablecoin for, let's call it, most stable currencies? I still don't know. That's something I've been thinking through. And I think there's a lot of very interesting projects that are trying to tokenize longer tail currencies that I think is pretty cool. But even if we just have digital dollars and a power law with those, I think there's a lot that we can already do around payments. And that's particularly around B2B, more so than B2C. I think the traction I've seen organically is the pull seems to be more with businesses, because for them, time counts. And it's important, like settlement that's more like real time instead of waiting days, weeks, and sometimes months. And basis points count, where if they're saving 50 to 100 bips like on volume, that is very valuable. And I guess like the hot take is that Ripple was directionally correct, I think, but it had the wrong tech stack, the wrong business model, wrong market timing, wrong economic model. But I think today with cheaper block space, embedded wallets, better on and off ramps, and general adoption of stables that has bled quite deeply into traditional like financial market infrastructure around like FX desks where they hold it at scale. I think there's a lot of opportunity here to use stables as effectively like the back end of a parallel financial system that can transmit value around the world in a way that's faster and cheaper than using SWIFT and credit card networks.
Wow. Really fascinating. I'm a huge fan of the stable use case. Also beginning to open up and see what's going on in AI, particularly the intersection of AI and crypto, and seeing what these large language models are doing when you marry them with smart contracts. So interesting projects there as well. But really appreciate you kind of helping us understand, well, your view on it and the directionally where you think it's all going. I love how you also coined AI as being like electricity, very revolutionary if you kind of look at how electricity changed the whole world, even up to this day. So, Dmitriy, just want to thank you so much for your time and for coming on. This has been very insightful, and thank you for being on, and hope to have you back soon.
Yeah, of course. Thanks for having me. This is fun.
Absolutely. Take care.
Bye.
Hey, everybody. Thanks for listening. If you enjoyed the episode, go ahead and give us a good 5-star rating and subscribe wherever you're getting your podcasts so you can get all the latest conversations from the most interesting founders, builders, and investors from across the world. Thanks so much and have a good one.